What if I told you that Bitcoin and the stock market might be walking into a danger zone? We're going to explore a fascinating hypothetical today, a rare signal that, in the past, has come before huge market moves. Imagine a scenario where the 1 week correlation between them spikes to 80%. A link that powerful, even if it's temporary, could be explosive. In this video, we're going to run a thought experiment. We'll look at what it would take for this kind of connection to trigger a wild move to $122,000 for Bitcoin. I'll break down the specific hypothetical conditions that would need to fall into place and the strategy I'd watch if this signal ever flashed for real. You've got to understand both sides of this coin because a correlation this high could be a massive tailwind or an anchor that drags Bitcoin straight to the bottom. Let's get into it. All right, so let's start with the big idea, because it's something that has fundamentally shifted over the last few years. For the longest time, the dream for Bitcoin investors was that it would be an uncorrelated asset, basically digital gold. When stocks tanked, Bitcoin was supposed to stand strong or even rise, acting as a safe place to park your money. And for a lot of Bitcoin's early life, especially before 2020, that was pretty much true. Its correlation with the S&P 500 was often low, sometimes even negative. It did its own thing, driven by its own halving cycles and adoption curve. But then the institutions arrived. As more big money flowed in, Bitcoin started getting pulled into the world of traditional finance. It began acting less like digital gold and more like a high-risk tech stock. Put simply, it became a risk-on asset. When investors felt bold and were buying stocks, they'd buy Bitcoin. When they got spooked and sold stocks, they'd dump Bitcoin too. This brings us to correlation. Picture two dancers. If they have a correlation of +1, they're in perfect sync. One lifts an arm, the other does too. If it's -1, they're perfect opposites. A correlation of 0 means their moves are totally random and independent. In the real world, assets are rarely at the extremes, but they dance somewhere in between. And in our hypothetical scenario, the dance between Bitcoin and the S&P 500 has just hit a critical and very synchronized moment. Let's imagine it's late 2025 and we're in a weird spot. Let's say that the 1 week rolling correlation between Bitcoin and the S&P 500 suddenly surges to 80%. What would that actually mean? It would suggest that for a short window, their fates are tied together. Now, why would I call this a dangerous signal? Because it completely changes Bitcoin's risk profile. When correlation is that high, Bitcoin temporarily loses its main superpower, being a portfolio diversifier. It's no longer a hedge. Instead, it becomes a leveraged bet on the stock market. Because Bitcoin's volatility is historically much higher than the S&P 500's, this high correlation could mean a 1% move up in stocks translates to a 3 to 5% rocket ride for Bitcoin. But it's a double-edged sword. A 1% dip in stocks could lead to a much bigger gut punch for Bitcoin holders. If the S&P 500 sneezes, Bitcoin could catch a brutal flu. This isn't just pure fantasy. We've seen this happen before. During moments of major market stress, like the COVID crash or rate hike scares, the 30-day correlation has spiked, sometimes topping 0.7. These are the moments when all risk-on assets get tossed out the window together. But what would make our hypothetical situation so interesting is the contrast with the longer-term trend. While short-term spikes make headlines, the 5-year correlation between Bitcoin and the S&P 500 has been in a much lower range of around 0.41. This just highlights how unusual and temporary an 80% spike really would be. They are anomalies, but powerful ones that traders can't afford to ignore. And this anomaly would be happening right in the middle of a bigger, more important story, a massive divergence. So here's the paradox. While we're talking about a hypothetical spike in correlation, the actual story of recent years has been a historic decoupling at times. We have seen years where the S&P 500 posted strong gains while Bitcoin was in the red. For example, in 2014 and 2018, the two assets went in completely different directions. So, what on earth is going on? Why would two assets that often move together suddenly go their separate ways for long stretches? There are a few theories. First, the AI gold rush. Capital has been stampeding toward artificial intelligence. AI-related stocks have been a primary driver of the S&P 500's performance. For investors hunting for high-growth, speculative returns, AI became the shiny new toy, pulling attention and billions of dollars away from crypto. Second, major headwinds from Bitcoin ETFs. After a phenomenal launch in January 2024, the spot Bitcoin ETFs, once seen as a source of endless buying, have hit turbulence. We have seen periods of sustained net outflows, with some days seeing hundreds of millions of dollars leaving the ETF complex before recovering. Even BlackRock's massive IBIT fund has experienced significant single-day outflows. This creates huge selling pressure that Bitcoin has to absorb. And third, there's a fascinating structural shift happening: the miner pivot. The Bitcoin halving squeezed mining profitability. In response, we're seeing an emerging trend where large, publicly traded mining companies are starting to repurpose their operations. Companies like Core Scientific, Riot Platforms, and Bitfarms are exploring or actively pivoting to power energy-hungry AI data centers. While they aren't abandoning Bitcoin, this move shows that some of the smartest money in the mining space is hedging its bets on the explosive growth of the AI economy. These three forces, the AI boom, ETF outflows, and the miner pivot, created this great divergence. They help explain why Bitcoin has struggled at times while the stock market soared. But now, with our hypothetical 80% correlation signal flashing, a new and temporary scenario could be on the table. So how do we get from a story of decoupling and headwinds to a hypothetical Bitcoin price of $122,000? The entire answer lies in the temporary but powerful recorrelation we're imagining. If an 80% link were to hold, it would mean Bitcoin's fate is temporarily dictated not by its own issues, but by the sheer momentum of the stock market. This creates a clear, multi-stage scenario for a massive price surge. Here are the conditions that would need to be met. Condition number 1, the S&P 500 has to keep rallying. The stock market must maintain its bullish fire. Whether it's a Santa Claus rally or positive economic sentiment, the S&P 500 has to lead the charge. Condition number 2, we'd need to see a capital rotation. The AI trade, which has been so dominant, might start to look a bit crowded. Investors who've made a killing in tech stocks could start hunting for the next high beta play to multiply their gains. With an 80% correlation signal active, Bitcoin would become the most obvious candidate. It would become the leveraged NASDAQ trade. Condition number 3, Bitcoin would need to reclaim a key technical level. Let's say the price is hovering around a support level, like $90,000. For a true breakout, Bitcoin would need to decisively push through the noise and establish a firm base above the psychological $100,000 mark. Crossing that level would be a massive signal to sidelined money that the downtrend is over. If you combine those three conditions, a rising S&P 500, a rotation of capital, and a technical breakout above $100,000, the stage would be set. In this kind of setup, analytical models and chart patterns could project that this high correlation link could pull Bitcoin up dramatically, with a target range of $108,000 to $122,000 becoming a distinct possibility. Now, this is a very fast-moving hypothetical. This 80% correlation would be a powerful signal. But as history shows, these spikes are temporary and can break down at any moment. If you want to learn how to use these signals to make money, feel free to check out my Macro Investors Masterclass in the description. The first module, including 5 lessons and a quiz, are absolutely free. This is absolutely not financial advice. This is just a breakdown of the strategic framework I'd use to think about this kind of setup. How you act should depend entirely on your own risk tolerance. There are 3 ways to look at this. First is the bullish S&P view. what I'd call the leveraged play. If you're bullish on the stock market, a high correlation turns Bitcoin into a powerful tool. It becomes a way to get supercharged returns on that belief. We've seen this before. In 2022, the S&P fell about 19%, but Bitcoin plunged nearly 65%. On the flip side, in 2023, the S&P rose around 26%, while Bitcoin exploded by roughly 150 to 160%. It's a beast that amplifies moves in both directions. Second is the neutral or diversification view, the balanced approach. This is for folks who are less sure about the market's next move, but want long-term Bitcoin exposure. This strategy relies on Bitcoin's low long-term correlation, not a temporary spike. The goal is to build a portfolio that can handle different seasons. However, you'd have to accept that during these high correlation spikes, your diversification benefit temporarily vanishes, and you're just taking on more risk. This brings me to the third and most important view, the risk management view, or the decoupling watch. The most critical part of any strategy is knowing when it's wrong, and an 80% correlation signal would, by definition, be temporary. These spikes rarely last more than a few weeks before they drift back to their baseline. So what are the signs the signal is breaking down and the hypothetical trade is over? First, you'd watch the correlation metric itself. If you see it fall from 80% back down towards the 0.3, 0.4 range, the direct link is weakening. Bitcoin is going back to trading on its own terms. Second, you'd watch the ETF flows. If you see a sustained return of big net inflows into the spot Bitcoin ETFs, especially while the stock market is flat or down, that's a huge crypto-specific buy signal. It would tell you that the internal headwinds are clearing up. And finally, you'd watch for the ultimate sign of decoupling, a situation where the S&P 500 starts to stall or pull back, but Bitcoin holds its ground or even starts to climb. That would be the definitive signal that the great divergence is back in charge, and a new chapter, driven by Bitcoin's own unique story, has begun. So, to wrap this all up, we've explored a hypothetical scenario where Bitcoin and the S&P 500 are locked in a rare 80% correlation. This has created a battlefield between two powerful and opposing forces. On one side, you have this theoretical, short-term signal that would temporarily tie Bitcoin's fate to the stock market, creating a narrow path to a potential price target of $122,000 if stocks keep rallying. On the other side, you have the bigger, real-world structural story, a historic trend of decoupling, driven by the AI capital rotation, major ETF outflows, and a strategic pivot from crypto miners. The key to navigating the market is understanding which of these two forces is in control at any given moment. This hypothetical correlation signal offers a clear window of opportunity and risk, but that window would be closing fast. The coming weeks will be absolutely critical in determining whether such a connection could ever hold long enough to trigger the next big move, if the great decoupling will reassert itself as the dominant narrative. I'll be covering it every step of the way. If you got value from this deep dive analysis, do me a favor and hit that like button. And let me know your thoughts in the comments. Do you think a tight correlation with stocks is Bitcoin's ticket to new highs? Or is the decoupling story the real one to watch? Thanks for watching, and I'll see you in the next video.